Our next and last example for this CD is going to be a relatively short-term trade on the ES futures contract or the S&P E-mini contract. And there's a couple lessons I want you to learn from this example. One is that even if you get stopped out of your initial trade position with a small loss, if the trade conditions on the higher time frame continue, then enter on the next smaller time frame setup. So it might take one or two or maybe even three entry attempts before you're successfully in a trade where the trend continues in the direction you anticipated. And the second is that we manage the trade on the position of the higher time frame that we use to enter the trade. This example will be 60-minute and 15-minute data. So we basically manage the trade in respect to the position of the higher time frame 60-minute, even though that we're executing on the 15-minute. And you'll see through this example how we could have moved up to a higher time frame for a longer term trade, but we manage the trade with the data that we use to enter the trade on. So let's get started on this ES short-term trade example. We have showing the 60-minute data for the ES futures contract. That's the S&P E-mini contract. And let's take a look at the position of this market. We're going to be looking at the 60-minute and 15-minute data for a possible very short-term trade setup. Could be a day trade, might be a swing trade that lasts a day or two or three. We could use this information for an even longer term position, but let's just focus on the kind of short-term position that we use with just the intraday data. So as of the last bar in the chart, which is the first 60-minute bar on, let's see, what day is this, February 13th, we had a bullish reversal in the 60-minute momentum. Now the 60-minute is going to be our higher time frame, and we're going to execute and manage the trade from the 15-minute data. So as of the last bar in the chart, more than likely the S&P would be sideways to up for a few 60-minute bars. The upside might be fairly limited. We have just the simple retracements, internal retracements on a 62 and 78%, and it's just a few ticks short of the 62% retracement. Plus, let's take a look at another factor, and that's the time factor down here. Now, I haven't put all the time relationships right on the chart. I just used the dynamic time projection report, which does all those relationships and gives a score for each bar, as you've seen in prior examples. But we have, let me get the crosshairs, right around 11:30 of February 13th, plus or minus about a bar or two, should be what we call a 60-minute top, or a top that would last for 6 to 8 to 10 60-minute bars, otherwise for several hours. So the upside is fairly limited in time and possibly in price. Let's do some other price relationships. Let's do our alternate price projections from both these swings up and see if we can focus on one or two or the other of those two retracements. Well, it just so happens that one of them falls just within ticks of the 62% retracement and one of the 78. So it doesn't indicate by the alternate price projections which of the two retracements is more likely to be the target for this part of the rally, at least. Let's do the external retracements of this last section down. We can just get rid of the 262%. And, well, those two also fall right in these very narrow price zones, 127%, just a couple ticks from the 62% internal retracement, and then the 162% external retracement right near the 78%. So we're not going to be able to determine in advance which of the two retracement levels is likely to be the target, because they both have one projection from all three of the sets that we did. But we'd want to look at the time position if this market continued up and reached one of these two levels, as well as the momentum position as it continued up. to determine, help qualify out which one it might be. Notice that I have labeled this an A, B, C, D. Don't really need to get hung up in any particular labels, but we had this overlap, and frequently intraday overlaps, if they're only by a few ticks, are kind of suspect, but we've got at least 2 bars that overlapped into this first section up. So more than likely, this is a correction coming up and not what we call an impulse trend or a bull trend that's going to take it to new highs. So when the correction's complete, if it's making a correction, we'd anticipate that the S&P would decline to a new low. So we're going to focus on, because the upside might be fairly limited, focus on identifying the next top, which is possibly the top of a correction, for a short trade. And so the first thing we're going to be looking for is when the momentum gets overbought or makes a bearish reversal. Once it's either overbought or makes a bearish reversal, we're going to move down to the 15-minute data for our entry and trade management strategies. So let's add some bars on the chart. There we go. It looks like as of the last bar in the chart, both lines are in the overbought zone. We can see they're both above 75. So the upside should be very limited before we have a reversal and a decline that lasts at least several hours, if not makes a decline to a new low. So we want to now move down to our 15-minute data for entry strategies for a short position. So it's important to stress here before we go to the 15-minute data is that we looked at the position of the market in advance, and then we identified what conditions must be made before we consider the trade. And we're not right now, by the way, let me just look at this timing. Yeah, it's exactly on the 11:30 bar. So this is also right in the time target to make a 60-minute high. Just kind of dead on that bar. We don't know if that's the high or not, but we know that it's at the price resistance focused around the 62% retracement, time resistance with momentum overbought. So now let's go to the 15-minute data. So now we're showing the 15-minute data, and as of the last bar in the chart is the same time that the 60-minute momentum became overbought, and the price had moved up to right near the resistance area surrounded by the 62% retracement. I'm only showing the retracement just to keep the chart kind of clean, but there's also the 100% APP and the 127% external retracement right around this area. And of course, it's right on the time resistance around late morning of the 13th for a 60-minute high. So our entry strategy will be to enter a short position following a 15-minute momentum bearish reversal on the 15-minute trailing 1-bar low. So we have to wait until the 15-minute momentum makes a bearish reversal. We already know the higher time frame 60-minute is overbought. We have to wait for the 15-minute to make a bearish reversal before we look to execute a short trade. Now I'm going to manage these trades, or this trade, based on the 60-minute data, which means could be a very short-term day trade, or at the most a trade that lasts for maybe about a day, maybe into the next day. Because right now we've set the trade up on the 60-minute data. That's our higher time frame, and we'll look for momentum position on the 60-minute data to help manage the trade. We could use this information for a longer-term trade if we're anticipating that this is a correction and possibly making a corrective high followed by a trend down to a new low. We could use the same information for an entry with a very small capital exposure on a much longer term trade that would last days to maybe even weeks. But if we were going to do that, we'd have to go to the even higher time frame daily data than to manage the trade for a longer term position. I'm going to stick with the 60-minute and 15-minute for fairly short term trade. Okay, let's add some data bar by bar onto the 15-minute chart until we get that momentum bearish reversal. In fact, let's set up just an alert for that reversal. So we'll be alerted to the bar that reversal is made. Okay, I got the alert set up. So let's add, we're in our training mode as usual, and add bar by bar until we get that momentum reversal. There we go. We got it 2 bars later. Bearish reversal on the 15-minute momentum. So now our entry strategy is to trail a stop to enter 1 tick below the trailing 1 bar low on the 15-minute data. We'll set another alert for that. Okay, so let's add some bars and see if we get stopped into the market. Well, we did on the next bar. See, it's amazing when those momentum reversals are made, how often the market follows sideways to down. So we got filled. We entered the market 1 tick below that 1 bar low, so we entered at 1363. Our stop is at the high. We don't have a new high, so it's 1366.75 plus a tick, 1367. So we have, what's that, about a 4-point capital exposure. Now, how are we going to manage this trade on the downside? Well, what if we're incorrect, and this is completing a larger degree corrective high, and it's only making just a very short-term decline, short-term correction before it continues higher. Remember, we manage our stops in the first unit as if we're wrong about the larger time frame position, and this market is only making a short-term correction. So if that's the case, it should get down at least at 50%, 62% minor retracement zone. I'll just put that in, otherwise around 1353. And we're going to look for, if the market reaches 1353.25 or lower, and I should say, the 15-minute momentum makes the second bullish reversal, we will then trail our stop 1 tick above the trailing 1 bar high. So either reaching 1353.25 or 2 smaller time frame 15-minute bearish reversals. Either of those conditions, we're going to trail the stop at the 1 bar high in the 15-minute data. For the short-term unit, we're going to keep the stop quite a ways away from the market. We're not going to adjust it on the second unit very frequently, because we want to hold the second unit at least until the 60-minute data becomes oversold. Okay, because our higher time frame is 60-minute data. Again, you could move up to the daily momentum and daily data for a longer term trade, but since we use the 60-minute position to enter our this position, the short trade, we're going to use it to manage the second one, and we're going to look to exit when the 60-minute momentum gets oversold. Now, how are we specifically going to manage it if it reaches that? Well, we're going to see as the market comes down the different swing highs and lows it might make in the smaller time frame momentum position to hopefully be able to adjust the stop much closer to the market activity if it's declining before the 60-minute momentum is oversold. But we have our specific trade strategy for the short-term unit and the general trade strategy for the longer-term unit. So let's add some bars and see first if either of these short-term conditions get met. So we've got 1 bullish reversal on the 15-minute data. Now we just got stopped out because our stop was 66 or 67, excuse me, and we've just gone above 67. I could have drawn a little line with a price alert by it. Should have done that probably ahead of time, but let me take this out. And so we're stopped out of both positions because the market went higher and made a new high. So we have but a very small and manageable loss. So does that mean that we abandon any consideration for continuing the short trade? No, as long as that 60-minute momentum is overbought or bearish, we'll consider short trades on 15-minute momentum bearish reversals. And it's definitely going to still be overbought as of this bar, which is the 1330 bar. I'll go ahead and add that bar onto here. You want the 1330 bar, there it is. And it's made a bearish reversal from the overbought zone. So it's in a position for short trades on smaller time frame. Nothing's changed in any of the conditions to consider a short trade. Back to the 15-minute data. What's our trade strategy? Well, should it be any different than what we just had? No, same thing. Following the next 15-minute bearish reversal, we're again going to initiate the entry strategy on the 1-bar trailing low with the same type of objectives on our trade management. So let's just add some more data. I'm going to put that alert back on, just cleaning the chart up here a bit. And I'll put the momentum reversal alert on. Okay, we just had our bearish reversal in the 15-minute data. Our higher time frame data is our momentum is bearish. It made a bearish reversal on the last 60-minute bar. Now we want to enter another short trade on the trailing 15-minute 1-bar low. So I put an alert on that. Let's add some data. Up, next one. And we have an entry, 1366. Our stop, 1370.75. So about 4 3/4 points capital exposure per contract. What's our objective? Same strategy we just talked about. We're not going to change our strategy. Nothing's really changed here. Just the price level. If the ES declines to 1355 or following the second 15-minute momentum bullish reversal, we'll trail the stop on the 1 unit, the short-term unit, 1 tick above the 15-bar high. Let's add some bars. There we have 1 15-minute bullish reversal. Just turn bearish again. Get my cursor out of the way. And there we had a second 15-minute bearish reversal. I was focusing down here. Looks like 1 bar earlier we reached 1355. So now let's trail the stop to exit the short-term unit 1 tick above the 1 bar high. So let me put the put that alert in. Got stopped out the next bar. So we exited the short-term unit. Let's see. Oh, I had the wrong. At 1358. I'm just going to clean the chart up. Short 1366, exited 1358 for an 8-point gain on one of our units that was short. So let's add more data and see our trade strategies for the second unit, anticipating that the market's going to continue lower. However, let's first look at our 60-minute momentum, just in case it's reached the oversold zone. And this is as of the last bar's 10:15. Be 10:15 the following day. So as of the last completed 60-minute bar, there we go. It'd be actually the 9:30 bar. Only the fast line is in the oversold zone. So we're not going to adjust the stop close to the market quite yet, but following the next 15-minute bearish reversal, we'll adjust the stop, excuse me, on the second unit to the swing high made following the 15-minute bearish reversal. So our stop is still one tick above that high, and there's just no reason to bring it closer right now. Let's add some more data. Okay, we just made another 15-minute bearish reversal. What was our strategy? Adjust the stop a tick above the minor swing high made prior to the reversal, and that's now at 1360.75, so 1361 is our new stop. And we're ensuring at least a 4-point gain on that second unit, even if we get stopped out. So we want to add data until the 60-minute becomes oversold. I'm just going to look back. That's as of 11 o'clock. Our last bar is 9:30 in the 60-minute. We can add another bar. And so far, both lines are not oversold. The slow line is not, or the slow line is not yet oversold because it's not below 25. So our next 60-minute bar that has the potential for both lines being oversold is going to be the 11:30 bar on the 15-minute data. So we'll add bars till we get to the 11:30 bar, then we'll take a look at the 60-minute data again. And the last bar so far is the 11 o'clock bar, so we've got 2 more bars to go. This is the kind of switching back and forth we have to do in a training mode when we're using intraday data, really any time frame data, so that we can do proper training. Let's do another bar. It's lower. Another bar, kind of even with the prior one. Let's take a look at the 60-minute 11:30 bar. We're going to add one more bar, and now we're in the oversold zone with a 60-minute bar. We only had a very small decline so far. But if we're oversold in the 60-minute bar, we're going to now trail our stop in the 15-minute data following the next 15-minute bullish reversal at the trailing 1-bar high. So the next 15-minute bullish reversal. And notice that we're exiting on similar conditions than how we entered. We began our entry strategy when the 60-minute momentum was overbought. Then we went to the 15-minute, looked for the next 15-minute bearish reversal to initiate our entry strategies. We're doing the same on our exit strategy in this fairly short-term trade. 60-minute momentum is oversold. We're going to the 15-minute looking for a bullish reversal to start trailing our stop at the 1-bar high. As of that bar, we got a bullish reversal. Now we're going to trail our stop 1 tick above the 1-bar high. I'm going to put the alerts in again because sometimes I just start clicking away and adding bars without paying attention here when I'm in the training mode. Okay, so let's add bars. Just got stopped out on the next bar. So where did we get stopped out in the intermediate term unit? 1356.50 it would be. So we had almost a 10-point gain on the second unit. Very short-term trade. We entered it the afternoon of February 13th, and then we were out around midday on February 14th. So we had on this whole little campaign, we had a loss on our first entry of a little over 4 points on both units because we were stopped out on our initial protective buy stop when it made a new high. Then we re-entered. We had a small gain on the first unit and a little bit better gain on the second unit that more than made up for the initial loss. Now, does this market have much further down to go? Well, if we looked at higher time frames, we'd say probably. We would probably have much further down to go, possibly even making a new low if this is completing a corrective high. And if we wanted to trade for the longer term, we would move up to the daily time frame for our conditions, for setup conditions for a higher time frame, longer term trade. But this is how we can use just the intraday data for very short term trades in the same manner that we use weekly and daily data or daily and 60-minute data for swing and position trades. Well, we've only shown a few trade examples on this CD, and some of them we've gone through in very much in detail, others a little bit quicker. The trade plan and decision-making process is the same for any market and any time frame and any conditions. So the most important thing is for you to understand the four main factors that were taught in the book: dual time frame, momentum, price position, time position, pattern position, as well as all those trade management strategies from the objective entry techniques right through trade management on adjusting the stop through the exit strategies. So I know that if you apply all the principles you've learned in the book and the CD to whatever markets that you're interested in trading, I'm sure you're going to find great success if you take the time to learn these principles and their applications. Well, thanks again for purchasing High Probability Trading Strategies. I'm confident if you take the time to master and apply the strategies that you learned in the book and this CD to your own business of trading, whether it's futures or Forex or stocks or ETFs or any other actively traded market, that you're going to find great success. For more recorded trade examples and other online tutorials for just readers of high probability trading strategies, go to our book website at www.highprobabilitytradingstrategies.com. The website includes a book owner's only password protected section, and you'll be asked a password that you'll find in the book. I look forward to your success and meeting with you at one of our online tutorials or one of our live workshops. Thanks again for joining me, and I hope to meet you soon.